The other key area of the economy that could be affected by a rise in unemployment is housing. Right now, it's showing clear signs of recovery, but that could quickly evaporate if there's a sharp jobless rise or if interest rates have to keep on being pushed higher. Cameron Kusher is the Executive Manager of Economic Research at REA Group and joins me now from Brisbane. Cameron, always good to chat to you. That's one of the real issues for the housing market right now. Knowing the Reserve Bank thinks that unemployment will go higher, just what impact that might have on the housing markets over the next 18 months or so?
It's a really tricky question, Ross, and it's one we're sort of grappling with ourselves when we think about where property prices are going to go over the next 12 to 18 months and more broadly just what's going to happen with the housing market. As you said, the Reserve Bank is saying that they think the unemployment rate needs to rise to around 4.5% in order to bring inflation back down into target range. And obviously that would mean that people are put out of employment. Some people, unfortunately, maybe overstretch themselves, lose their job, can't get back into another job, and would then have to sell their home. So it is certainly a potential challenge for the housing market. The other one, as you said, is that higher interest rates. Every time interest rates go up, servicing that mortgage gets more expensive for people. And the higher interest rates go, the closer it pushes some people to the edge and having to sell their home.
So just tell me, I mean, over the past even 10 years, I guess, we've seen almost no distressed home loans in Australia. There's been very little activity of that type since the global financial crisis. Is there been any sign that there's an increase in distressed sales over the last little while?
Well, we've seen that the mortgage arrears rate has drifted slightly higher, but as you said, on a historic basis, it's still extremely low. I think the tricky part here, though, is that so many people fixed their mortgage rates during the pandemic, and they fixed their mortgage rate at around 2%, maybe even a little bit lower than that. And they fixed and they plan to roll off that fixed rate period maybe this year or looking into next year or even early 2024. Thinking that interest rates would still be down where they were. So yes, your variable rate might have been your fixed rate might have been 2%. You'd roll into a variable rate of maybe a little bit higher than that. But the reality now is that 2% interest rate is going to a 6% interest rate on your mortgage. And people certainly didn't bargain for that. And unless they've seen a big increase in their wage or they've come into some money some other way, it's going to be very hard for a lot of households to stomach that big increase in mortgage repayments.
But they're the people who also would have seen big increases in their equity during that period of time. The last 3 years or so have been pretty good for housing. The question is whether there's people out there with negative equity who, if they lose their job and forced to sell, will be underwater and the banks pretty much have to take it over.
That's exactly right. And I think in terms of, yes, property prices have risen a lot over recent years, but it is a timing thing, right? So price growth was very strong through 2020, was very strong through 2021. But if you sort of bought in mid-2021 to late 2021 and through last year, then you haven't really seen much property price growth. Maybe you haven't seen much wage growth. And if you took out that short period of fixed rate mortgages, maybe you're facing a very steep increase in your mortgage repayments. So it is definitely something to be concerned about. The Reserve Bank a few months back had some data that showed that they expect that as people roll off, about 16% of households won't have the extra income to cover those mortgage repayments. Now, 16% is obviously a small amount of 100%, but when you think about that in the number of households, it's quite a large number of households that are facing some pretty steep headwinds when their mortgages do reset.
And so it comes back to this whole notion of employment. If you have income, then you can keep managing, you can cope in some way, you can find extra income, extra work. But it's as soon as that income stops, that's when really the music stops also for many of those householders.
100%. If you don't have that income coming in, a lot of people, you can maybe redraw on equity for a little while, maybe you can borrow some money for a little bit, but people need to have those incomes to continue to pay these mortgages. And this is more so than it's been in the past because the size of mortgages are much larger than they have been historically. And for the last decade, interest rates have only been falling. This, for a lot of borrowers, this is the first time they've ever faced higher interest rates. And I guess in a lot of ways, people thought inflation was dead and buried, and it's proven not to be. So it's been a bit of a nasty shock for households, and it's going to continue to be for a number of years.
Cameron Cush, always great to get your insights. Many thanks for your time today.
Thanks, Ross.
Cameron Cush there. Well, coming up after the break, we have an exclusive interview with the Managing Director of IBM Australia, Nick Flood, on artificial intelligence, data hacks, and who business operators and consumers will place their trust in the future.
This program is brought to you by realestate.com.au, Australia's #1 address in property. With more properties for sale than anywhere else, we make it easier.